Have you ever noticed how the news talks about prices slowing down, but then sometimes it mentions prices actually going backward? These might sound similar, but they representing very different economic scenarios. Disinflation and deflation are distinct economic concepts relating to price changes. Disinflation refers to a slowdown in the rate of inflation, meaning prices are still rising but at a slower pace than before. Deflation, on the other hand, describes a sustained decrease in the general price level of goods and services, indicating that prices are actually falling. The core difference lies in the direction of the price movement. Disinflation is about the acceleration or deceleration of price increases. Imagine a car that is still moving forward but gradually pressing the brakes. It is slowing down, but not yet reversing. This can happen due to various factors like tighter monetary policy, reduced demand, or increased supply. Deflation, however, is when the car shifts into reverse, meaning prices are unequivocally declining. This is often caused by a significant drop in aggregate demand, technological advancements that drastically reduce production costs, or a contraction in the money supply, leading consumers to delay purchases anticipating even lower prices. To identify these conditions, economic analysts closely monitor the Consumer Price Index, also known as the CPI, and the Producer Price Index, or PPI, when the annual percentage change in the CPI shows a smaller positive number than the previous period. That indicates disinflation. For example, if inflation falls from 8% to 3%, that is disinflation. If the CPI shows a negative percentage change, meaning prices are lower than they were a year ago, that signifies deflation. These metrics help paint a clear picture of whether the economy is experiencing slower price growth or actual price declines. Understanding this distinction is vital for economic analysis because policy responses differ significantly. Disinflation, representing a positive but falling inflation rate, is often a goal of central banks trying to bring an overheating economy back into balance without causing a recession. Deflation, however, is generally viewed as a much more serious economic threat because it can lead to reduced spending, decreased business profits, and increased unemployment, potentially spiraling into a deflationary trap. Mastering the difference between disinflation and deflation provides a clearer lens through which to understand economic reports, central bank policies, and the broader health of an economy. It helps you accurately interpret trends and avoid misjudging the underlying forces at play in the market.